The institutional digital asset insurance market is one of the most significant gaps in the crypto risk management ecosystem. Despite over $1 trillion in total digital assets outstanding, less than 5% of institutional crypto holdings carry meaningful insurance coverage. This gap reflects the genuine difficulties insurers face in underwriting a new asset class with novel risk profiles, but it also reflects institutional risk management programs that have not yet developed comprehensive digital asset risk transfer strategies. The insurance gap creates an important institutional risk management question. If traditional insurance is unavailable or prohibitively expensive for the full value of digital asset holdings, what combination of insurance, self-insurance, position sizing, and operational controls provides the most cost-effective institutional protection framework? This question does not have a simple answer, but it has a structured analytical approach that institutional risk teams can apply systematically. This analysis covers the current state of institutional crypto insurance, what coverage is available, what the major exclusions and limitations are, how the Lloyd's market and specialized insurers are developing digital asset products, and how institutional programs should structure a comprehensive risk transfer and retention strategy for digital asset portfolios. Custody insurance is the most developed institutional crypto insurance product, and the one most directly analogous to traditional financial institution crime coverage. Major institutional custodians including Coinbase Prime, BitGo, and Anchorage Digital carry custody insurance from Lloyd's market syndicates for a portion of assets under custody. This coverage protects against the specific losses that sophisticated institutional custody operations face: hacking of custody systems, insider theft by employees with key access, and physical loss or destruction of cold storage hardware. The critical limitation of custody insurance is capacity. The aggregate coverage available from the Lloyd's market and specialized carriers cannot fully cover the total assets held by major institutional custodians. A custodian holding $5 billion in assets may carry $500 million to $1 billion in coverage, leaving the majority of assets in the self-insurance or contractual limitation category. Institutional depositors with large custody balances should verify their custodian-specific insurance coverage amount and the contractual limitation of liability for losses exceeding that coverage. Smart contract insurance from on-chain protocols like Nexus Mutual and Insurace is a genuinely innovative category that addresses a risk traditional insurers have been unwilling or unable to underwrite. These protocols allow DeFi users to purchase coverage against smart contract exploits for specific protocols. The coverage is funded by other protocol users who stake tokens as capital and receive premiums in return. The coverage amounts are limited and the underwriting process is community-based rather than actuarially rigorous, but it provides meaningful risk transfer for smaller DeFi positions. The institutional crypto insurance program structure reflects the reality that full insurance coverage is unavailable and that risk management must combine purchased insurance, operational risk controls, and self-insurance reserves to address the total digital asset risk profile. This combined approach is consistent with institutional risk management practice in other non-standard asset classes where full insurance capacity is unavailable. The crime policy extension is a frequently overlooked insurance optimization. Many institutional crime policies were written before digital asset inclusion became a consideration and do not specifically address digital asset loss scenarios. Adding a digital asset endorsement to an existing crime policy is typically less expensive than purchasing a standalone digital asset crime policy and provides more comprehensive coverage integration with the broader institutional crime program. Operational risk controls are the most cost-effective component of the institutional crypto insurance program because they simultaneously reduce insurance premiums and reduce the probability of actual losses. Insurance underwriters for digital asset custody programs specifically evaluate operational controls in setting premium rates. Institutions with robust multi-SIG custody, documented approval workflows, and annual security audits receive meaningfully lower premium rates than institutions with less mature operational control environments. The insurance exclusions reveal the most important gaps in institutional crypto risk coverage. The DeFi exploit exclusion is perhaps the most operationally significant for institutions with active DeFi strategies. Any assets removed from custody insurance coverage and deployed into DeFi protocols are entirely at risk of uninsured smart contract exploit losses. This means DeFi deployed assets must be sized as if zero recovery is possible in a worst-case exploit scenario. The counterparty default exclusion directly addresses the FTX scenario. Institutions that lost assets in the FTX collapse could not recover through their custody insurance because custody insurance covers theft, not exchange insolvency. This exclusion underscores why the post-FTX institutional standard requires counterparty exposure limits sized for total loss rather than relying on insurance to cover exchange default risk. The regulatory seizure exclusion is underappreciated by many institutional crypto risk teams because regulatory seizure has been rare in practice for compliant institutional investors in major jurisdictions. However, institutions with global crypto operations that include assets in non-US custodians, exchanges operating in evolving regulatory environments, or DeFi protocols subject to uncertain regulatory classification should specifically understand whether their insurance policies provide any coverage for regulatory action outcomes. The insurance market capacity data illustrates the scale of the coverage gap in institutional crypto risk management. Total digital assets held in institutional custody are estimated in the hundreds of billions, while total available insurance market capacity from all sources is estimated at approximately $5 billion, less than 3% of institutional custody assets. The gap is not a short-term market inefficiency but a structural reflection of insurance market capacity development relative to the pace of institutional crypto adoption. The Lloyd's market is the primary source of institutional digital asset custody insurance, with specialized syndicates that have developed underwriting expertise for this novel asset class. Lloyd's capacity has grown significantly from its early limited offerings, but remains constrained by reinsurance capacity limitations and the relatively short loss history available for actuarial pricing. As the market develops longer historical loss data, reinsurance capacity should expand and primary insurance capacity should follow. On-chain insurance through protocols like Nexus Mutual represents a structurally different capacity source that is independent of traditional reinsurance constraints. The capacity is funded by protocol stakers rather than reinsurance treaties, theoretically allowing the market to grow faster than traditional insurance capacity. In practice, on-chain insurance capacity is still limited relative to institutional demand and has specific coverage limitations that prevent it from serving as a full substitute for traditional institutional insurance products. The self-insurance reserve calculation provides institutions with a structured methodology for quantifying the capital reserve required to cover uninsured digital asset risk. The calculation moves from total exposure through insurance coverage to probability-weighted expected loss and finally to a reserve requirement that accounts for partial recovery in most realistic loss scenarios. The probability of loss estimation is the most subjective element of the calculation and should be benchmarked against historical data from comparable institutional custody programs. Large institutional custodians with multiple years of operating history and strong operational controls have experienced loss rates far below the probability that naive threat models would suggest. Institutions that use historical industry loss data rather than theoretical worst-case scenarios for their probability estimates will arrive at more reasonable self-insurance reserve requirements. The recovery rate assumption is also important. Not all digital asset losses are total losses. Exchange insolvencies like FTX have resulted in partial recoveries through bankruptcy proceedings. Custody hacks in some cases have resulted in partial recovery through law enforcement actions. Modeling the self-insurance reserve based on total loss in all scenarios will over-reserve relative to expected outcomes, while modeling zero recovery probability at all will under-reserve for the most severe scenarios. An institution-specific recovery rate assumption based on the specific risks in the portfolio provides the most defensible self-insurance reserve calculation. Institutional digital asset insurance is a developing market that has not yet reached the maturity required to provide full risk transfer for institutional crypto programs. This gap is a reality that institutional risk managers must address through a comprehensive program that combines available purchase coverage with operational controls that reduce the insured risk and self-insurance reserves that cover the unavoidable coverage gap. The long-term trajectory of the institutional crypto insurance market is toward greater capacity and more comprehensive products as the market develops longer loss experience data, as reinsurance capacity develops, and as insurance actuaries develop better models for digital asset risk pricing. Institutions that build relationships with specialist underwriters today will be positioned to access better products at lower premiums as the market matures. For institutions entering digital asset programs in 2024, the practical starting point is to maximize available custody insurance, extend existing crime policies with digital asset endorsements, document operational controls for underwriter review, and establish a self-insurance reserve calculation using the probability-weighted expected loss methodology. This comprehensive approach manages digital asset risk as effectively as possible within the constraints of a developing insurance market.